Don't want that. Okay. And I'm going to disable the waiting room so people can come in. Here we go.
All right. Are we ready? We're recording? Okay. We'll just have to skip the first part of it. Anyways, thank you everybody for logging in and being present for this NALS Lunch and Learn. We have just one announcement, and it's the Lunch and Learn for November. I will circle back around who our guest speaker is going to be. I think it's John Powers, but at the end I'll wrap it up and give more of his info. I don't have that pulled up on my screen. Today our guest speaker is Kellie Money with Frost Brown Todd. Kellie is in the Louisville office. She assists plan sponsors with navigating complex regulatory requirements related to their health and welfare, retirement, and executive compensation arrangements, including requirements under ERISA, the Internal Revenue Code, the Affordable Care Act, COBRA, and HIPAA. A lot of these agencies are really recognizable to a lot of us. She also reviews and negotiates the ERISA-related provisions of proposed pension plan investments on behalf of large pension funds. Kellie routinely prepares and plans documents, reviews agreements with third-party administrators and vendors, and advises on issues related to plan administration, including correction of retirement plan errors. She also provides guidance on plan fiduciary and governance considerations, including those specific to multiple employer welfare arrangements and association health plans. That is all a mouthful, and I'm sure she is going to be way more better at saying all of that stuff. Her topic is understanding your retirement and health benefit options after a layoff, and I will pass it on to Kellie Money to get started.
Thank you so much, Jennifer. Hi, everyone. Thank you for having me today. I really appreciate the opportunity to speak with you about how being laid off or furloughed impacts your benefits. I'm also going to talk about furlough too. As Jennifer mentioned, I work with employers on their benefit plans, but I've tried to focus this presentation today on what I think is important to you as employees. I'm also happy to take questions at the end, so you can put them in the chat box, and that will be monitored by Kellie. But that being said, I can't give any specific legal advice about individual factual situations, but happy to answer questions generally about the law. I also wanted to say that I'm going to be speaking in terms of what's commonly done among employers, but every employer is different, and your employer might do something different than what's typical. So it's very important to look at the terms of your employer's benefits documents, because those are the terms that are going to apply to you. So I think I'll share my screen to get my presentation up. Let's see. 1 second. Can you all see? Okay, awesome. And then one more thing. Okay, all right. So first of all, we will start with, I wanted to discuss the different terms that employers can use when they either want to temporarily or permanently end the employment relationship. So, because employers can use different terms. A furlough is a mandatory leave of absence or reduction in schedule. It's intended to be temporary and that the employee will return to work when the employer calls them back from furlough. Furloughs are often used when there is not enough work for everyone during a slow period, and the employer can avoid terminating people if they reduce their hours or put them on leave. Furloughs are most often taken in a single block of unpaid time. So we're furloughing you effective September 1, but we anticipate to call you back January 1 because we expect business to pick back up by then. But employees can also be required to take a certain number of unpaid hours or days off over a specified period of time. So rather than working your standard 40 hours a week, we're going to reduce you to 30 hours, and we anticipate that that reduction will last through the end of the year. That could be a type of furlough. A layoff, on the other hand, is usually considered a true end of employment because of a lack of work available or elimination of the position. And it's important to note too that a temporary furlough can turn into a permanent layoff if the employer notifies you later that it no longer intends to call you back. If you get a communication from your employer saying that you've been furloughed or laid off, it's important that you understand whether they expect you to return and they expect to call you back to work, or whether they intend for this to be a permanent end to your employment, because that will impact your benefits, as we'll discuss. So just as way of some general background, the IRS only allows you to take a distribution from your 401k plan if you experience a distribution event. The most common distribution events are termination from employment. You experience a financial hardship if your employer's plan allows hardship withdrawals, or you take an in-service distribution if your plan allows those and you're over age 59 and a half. But even if you qualify for a distribution based on one of these events, there is still an early withdrawal penalty that you may have heard of, the 10% penalty if you take a distribution before you're age 59 and a half. There are some exceptions to that penalty, and the most common one is if you're taking a distribution due to termination and you're over age 55, so it wouldn't apply then. There are also these new coronavirus-related distributions available in 2020 for people who qualify that I wanted to talk to you all about. Coronavirus-related distributions were created by the CARES Act earlier this year. They allow qualified individuals, which we'll discuss in a minute, to take up to $100,000 from their 401k plans in 2020. The distributions can be taken into income ratably in equal amounts over a 3-year period, which would allow you to pay the taxes due on them over the 3-year period, or you can report it all as income in 2020 and pay all of the tax due by the 2020 filing deadline. The distributions are not subject to the 10% early withdrawal penalty that applies to distributions taken before age 59 and a half. And coronavirus-related distributions can also be paid back in full or in part to an IRA or to a 401k plan if the employer allows you to pay them back. They have to be paid back within 3 years of taking the distributions. And the benefit of doing that is that you can still defer paying taxes on them if you pay the money back. So coronavirus-related distributions are only available to qualified individuals, and this is a pretty long list of people who are qualified. So it's anyone who has been diagnosed with COVID-19 by a test approved by the CDC, and then if your spouse or dependent was diagnosed with COVID-19 by a CDC test, you're qualified. And then if you, your spouse, or a member of your household experienced adverse financial consequences as a result of one of these 4 bullets rather. There are many things in the bullets, but being quarantined, furloughed, laid off, or having work hours reduced because of COVID-19, being unable to work due to lack of childcare because of COVID-19, closing your business or reducing your business's hours because of COVID-19, or having a reduction in pay or self-employment income, or having a job offer rescinded or start date delayed because of COVID-19. So as you can see, many people will be qualified individuals for purposes of these distributions. Employers are allowed to add coronavirus distributions to their plans for 2020, but they're not required to. So if your employer plan has added them and you qualify and you want to take a distribution, your employer would ask you to self-certify on a form that you meet one of these requirements. You wouldn't be required to prove anything or submit any documentation. You would just sign that self-certification saying that you meet one or more of the criteria. But even if your employer has not added the coronavirus-related distributions to the plan and you're otherwise eligible for a distribution from the plan, for example, if you're terminated, or if your plan has in-service distributions at age 59 and a half, you can treat that distribution as a coronavirus distribution on your own individual tax return. The benefit of doing that would be that you can take it into income over the 3-year period, or pay it back to an IRA or other 401k plan that accepts repayments. So that's something to consider. And then, okay, thinking about furlough and your 401k. If you're furloughed and your employer both anticipate that you'll return, you have not experienced a termination of employment. So that wouldn't be a distribution event under your 401k unless you meet one of those other requirements that I mentioned. For example, you have a hardship and your employer allows hardship withdrawals, or you're eligible to take an in-service distribution if your employer allows those. While you're on furlough, your account will continue to generate investment income based on what your account balance is invested in the market. And you can generally change your investment elections at any time through your plan's record keeper. So you still have control over your account balance, but if you're not working any hours while you're furloughed and therefore you're not getting a paycheck, you won't be able to defer any compensation to the plan at that time. If your furlough is not structured as a leave of absence and you just have a reduced schedule, you can keep deferring a percentage of your pay to the plan, and your employer will still have to give you match on those deferrals if your employer matches deferrals. But we have seen some employers stop or reduce the matching contributions during the pandemic, so that's something to consider. And if you are laid off, as we discussed earlier, a layoff is generally a termination of employment. If you're laid off, you have several options for what you can do with your 401k account balance, depending on how large your balance is and what your former employer's plan allows. So option one is to cash out. Most employers have designed their plans so that if you have a balance less than $5,000, they can cash out your account, meaning that they can close out your account in the plan and distribute your balance to you. If your balance is greater than $1,000, then they would have to roll it over to an IRA unless you tell them that you don't want them to do that. And we'll talk about rollovers in a little bit. If your balance is less than $1,000, they can just cut you a check. If you don't choose to roll over your balance and you take a cash distribution, you would be required to take that amount into income in the year it's paid, unless you qualify for the coronavirus related distribution treatment that we talked about earlier, and you want to take it into income over a 3-year period. You would also pay federal and state income tax on the amounts, unless any portion of it is made up of Roth deferrals or after-tax contributions. So just as an aside, Roth deferrals are amounts that you defer from your pay to your employer's plan, or that you can pay into a Roth IRA after tax. They've already been taxed before you contribute them to the plan or the IRA. And then when you get a distribution of those amounts later, you don't owe any federal and usually no state income tax on the earnings, on the amounts or the earnings that you have accrued on the deferrals. So Roth can make sense if you think you'll be in a higher tax bracket when you retire. So you would go ahead and get the tax out of the way now when you're in a lower tax bracket and not have to pay anything when the amounts are ultimately distributed to you. Your employer is required to withhold 20% for federal income tax before they pay you the distribution. That's a mandatory requirement. And then if you're under age 59 and a half, you'll also pay the 10% early distribution penalty on the amount on your own individual return, unless an exception applies. And I mentioned earlier that the most common exception is if you terminate when you're over age 55. Some plans also give you the option to take distributions in installments rather than in a lump sum, which would allow you to recognize the income over time. So that's something to consider if your plan allows that. Option 2 is to leave your balance in your former employer's plan. If your balance is greater than $5,000 at termination, your employer has to let you keep your balance in the plan until you reach normal retirement age if you want to leave it in there. And then as a side note, I should point out that for purposes of that $5,000 threshold, your employer can count any amounts that you've rolled over to their plan from a previous employer's plan, but they're not required to. That varies from employer to employer. So if you've, for example, you've rolled over $20,000 from a prior employer's plan into your current employer's plan, but you've only deferred $4,000 from pay from that current employer. Your balance is $24,000, but it's possible that your employer might not count that $20,000 for purposes of the $5,000 threshold because it was rolled over. So that just varies by employer. If you choose to keep your balance with your former employer, you won't be able to make any new contributions to the plan because you're no longer earning pay from that employer, but you'll still have control over your investment, and you'll still be able to choose among the investment choices that the plan offers, and you can generally change those at any time through the plan's record keeper. It's often beneficial financially to keep your balance in your former employer's plan because employers have lower record keeping fees than individuals would be able to get through an IRA, especially if you work for a large employer. So it's important to compare what the fees are in your employer's plan versus what they would be if you transferred your balance to an IRA. And you can get that information from your plan's record keeper, and then whatever IRA you're considering, they should have that fee information available for you to review. And then third option is to roll over your balance to an IRA or to a future employer's plan. So most employers accept rollovers from other 401k plans. So with that option, you would leave your balance in your former employer's plan and then ask that the amount be rolled over to your new employer's plan when you find a new job. There are two types of rollovers, direct and indirect. A direct rollover is when your account balance goes straight from your former employer's plan to an IRA or another employer's plan without you ever having to touch the money, which makes things very simple and easy from an administrative standpoint. The money also stays tax deferred since you never have any control over it. There's no taxes assessed at that time of the transfer. There's also an indirect rollover. With an indirect rollover, you would take a cash distribution of your account minus the 20% tax withholding that your employer has to take out for federal income tax. But you have to redeposit the amount of the withdrawal into an IRA or another 401k plan within 60 days of receiving the distribution in order to have that become a taxable distribution where you'd have to recognize it and pay taxes on it. You would also have to pay back the 20% withholding that your employer took out of your balance when they gave you the distribution. So that would just come out of your own pocket. If you don't pay back that withholding, that amount would be considered a distribution to you and you would owe tax on it. It would rarely ever make sense to do an indirect rollover. Some people might do it if they have an urgent need for cash that will be reimbursed quickly, like moving expenses for a new job. But most of the time you're going to do a direct rollover, and it would not make sense to do an indirect rollover. But you might see indirect as an option when you're thinking about whether to roll over, and I just wanted to explain the difference. If your 401k account is greater than 1,000, as I mentioned before, but less than 5, your employer doesn't have to let you keep your balance in the plan, but they are required to roll it over to an IRA in your name unless you tell them otherwise. Note that if you have Roth amounts in your account that you're rolling over to an IRA, those can only be rolled over to a Roth IRA. And it's the same with another employer's plan. They have to accept rollovers of Roth so that they can keep those Roth deferrals separate from pre-tax deferrals. It's kind of an administrative thing. I would say most employers allow Roth, but they don't all. So they don't, so you would need to check for sure to make sure you could roll it over. You can also roll over non-Roth amounts, so pre-tax amounts, to a Roth IRA, but you'll have to pay taxes on those amounts at the time of transfer. You might be interested in doing this if you think you'll be in a higher tax bracket, as I said before, at the time you retire and take distributions than you are now. IRAs may have more investment choices than your former employer's plan. That's something to consider, but the IRA might have higher fees. So as I said, it's important to compare the fees and figure out what makes more sense. So now I'm going to talk about plan loans. If you've been furloughed and you have an outstanding loan from your employer's 401k plan, and not all employers allow loans to be taken from their plan, but some do, so I wanted to mention it. And you have an outstanding loan, you've been paying it most likely through payroll deduction. That's the most common. So if you're furloughed and that's the way you've been paying, you're likely going to be required to continue to make payments on the loan while you're on furlough. You should contact your plan's record keeper and ask how those payments will need to continue to be made while you're on furlough if you aren't working any hours at all. If your furlough is just a reduction in hours, then you'll likely continue to pay your loan through payroll deduction. But if your paycheck isn't enough to cover the amount of the loan, the plan may allow you to pay by debit from your checking account or by check. If you've always paid your loan by debiting from your account or check, which is less common, then nothing will probably change for you. However, I wanted to mention the CARES Act did open up an opportunity for employers to offer loan relief to employees. It's optional relief, so employers were not required to offer it. But as part of that relief, if you have a plan loan outstanding on or after March 27th of this year, your employer can choose to suspend the payments through the end of 2020, and then payments have to start no later than January 1 of next year. The term of the loan can be extended by up to 1 year from the date it was originally due, and any interest that accrued during the suspension will be added back to the remaining principal, and the loan will have to be re-amortized over the remaining period. So it's worth checking with your employer to see if they've added that relief, and if you have an outstanding loan and are worried about the ability to keep making payments through the rest of the year, it's worth seeing if there's any relief available. And just in general with the COVID relief, the coronavirus related distributions, the plan loan, suspensions, it's possible that this could all be extended, because I think a lot of people, including Congress, probably thought that we would be done with this by the end of the year and that the pandemic would be over, but I don't think it's really looking that way. So it's very possible that this COVID relief will be extended into next year. So just be on the lookout for that to see what Congress does with all of this legislation. Okay, and then if you're laid off and you have a plan loan, most employers will not let you continue to make payments on the loan over time. But you should definitely confirm that with your employer and see what they require in case you are allowed to keep paying. Typically, the deadline to pay back the full balance of the loan is by the end of the next quarter following your termination. If you can't pay back the balance by the plan's deadline, the plan will treat the outstanding amount as a taxable distribution that you would have to take into income and pay taxes on. But the Tax Cuts and Jobs Act of 2017 allowed people to have until the next tax filing deadline to recontribute that amount to an IRA and avoid having to take it into income and pay taxes on it. So to the extent you're able to pay back some or all of the loan to an IRA by that tax filing deadline, you wouldn't have to recognize it as taxable income. Just a general word of caution that plan loans can be very complex. So it's important to speak with your plan's record keeper about your options after a layoff or furlough. And it would also be helpful to speak with a tax professional, because there are certain instances when a plan loan can be treated like a coronavirus related distribution if you qualify. Now, turning to health benefits. If you're furloughed, you may be able to continue your health benefits if your employer allows it. Your employer will have to get permission from the insurance company to allow you to continue to be covered on the health plan and any other insured benefits. I just wanted to let you all know that it's not entirely the employer's choice, and that has to be done. That would be done on the back end, where they would communicate with the insurance company and see what the company allows. So it's not entirely the employer's decision. If you can keep your coverage during furlough, your employer may allow you to pay your premiums when you return, or require that you keep making payments while you're on furlough. And that would have to be done with after-tax dollars, because you aren't getting a paycheck if it's a leave of absence type of furlough. If it's not, then you would be able to continue making premium payments on a pre-tax basis because you're getting a paycheck. If you aren't allowed to keep your coverage during furlough, your employer has to offer you the choice to elect COBRA, which we'll talk about right now. If you're laid off, you will not be able to stay on your employer's medical benefits unless you elect continuation coverage through COBRA. COBRA allows you to continue your medical benefits following a qualifying event. Termination of employment is a COBRA qualifying event that allows you to continue your current coverage for up to 18 months for medical benefits. And medical benefits include health, dental, vision, and sometimes an employer assistance plan if it offers medical benefits. And just as an aside, I wanted to tell you all about employer assistance programs, or EAPs as they're often called. They give employees access to things like free counseling sessions, childcare resources, legal assistance, debt management, and more. EAPs are usually always free to employees, and I think typically larger employers have EAPs, but it's worth exploring to see what your employer has available, to see if you can take advantage of some of those free resources. An employer that has at least 20 employees on more than half of its typical business days in the previous calendar year is required to offer COBRA coverage to any employee that experiences a qualifying event. Some states also have mini COBRA rules that aren't as robust as the federal COBRA rules, but they can apply to smaller employers that are below that 20 employee limit or threshold. I checked out Tennessee, and it looks like they do have a mini COBRA law that applies to all employers that provide health coverage through an insurance policy. Employers are required to offer at least 3 months of continuation coverage under that mini COBRA rule. So if you work for a smaller employer that provides group health benefits, mini COBRA would apply in Tennessee. The federal COBRA rules require that you be given notice of your COBRA election rights, along with anyone else in your family who had coverage through you. The COBRA election notice will explain several things. It will outline the process that you have to follow for electing COBRA. It will give you the deadline that you need to elect COBRA, and it will say who's eligible for COBRA. So if you had family coverage or employee plus one, all of those people will be eligible to elect COBRA, and they'll have their own individual election rights. The notice will also say the cost of COBRA, the due dates for payment, and where to send the payment. And I wanted to say too, the notice will often come from a vendor that your former employer will have contracted with to administer COBRA. WageWorks is a big one in this area. ADP is another. They provide COBRA services to employers. And so often those notices will come from those vendors. So don't necessarily be on the lookout for something that has a return address with your employer on it, but it will come likely, especially if your employer is large, from one of these vendors that provides COBRA services. COBRA can be expensive because you're continuing to pay the cost of your healthcare premium, but you're also paying the portion of the premium that your employer used to pay, plus up to a 2% administrative fee that goes to the COBRA vendor or to the health insurer. So it's possible that your employer might pay some amount toward your COBRA premium, but that's not likely. So it's likely that it will be pretty expensive, but still it's worth it to see if you can get a better rate on the healthcare exchange in your state when considering all of your options. And then I wanted to say something about life insurance and other voluntary coverages. So you may have group term life insurance through your employer and other types of voluntary coverages like critical illness or long-term care insurance. You should check with your HR department or your supervisor to see how you'll keep paying premiums for these benefits if you're furloughed and you're not getting a paycheck while on furlough, because these are often paid by payroll deduction. If you're laid off, it's possible that you can take these coverages with you if you want to. You'll just need to check with your employer and with the insurers to see what can be done. But with life insurance specifically, you'll have to convert it to an individual policy. The policy materials will explain how you need to do this, but there's usually a short window to convert it before the policy lapses. Employers often don't provide any information about converting life insurance or continuing these voluntary coverages after an employee is terminated. It's often overlooked, or they think that the insurance company is going to provide the information, but that does not always happen. So it's important that you be proactive and ask these questions and follow up with the insurance provider and your employer if they have any materials available that you can look at to see what needs to be done. So now I wanted to turn it back to questions because I figured there would be some questions. I wanted to turn my video back on too. There we go. Okay. Do you all have any questions for me?
If there are any questions.
One question.
Okay.
Sorry.
No,
One
go
question
ahead.
we did have, if we could have the presentation itself to share with the people that have been on the call.
Oh yeah, absolutely. Sure. I can just email that to you, Kelly, and copy Jennifer, and you guys can distribute it to everyone. Happy to share that.
Sounds great. The recording will be on Facebook and on YouTube, but this way they can have the actual presentation that was requested.
Definitely. Yeah, I think it's helpful.
So do we have anybody that has a question? Got any of the info?
I know this stuff can be kind of dense, and there's a lot of detail to it. So yeah, it can just be a lot to take in. But really, I think following up with your HR department or your supervisor and looking at all written materials is really important, because what's in writing will always be what governs in the end, no matter what you're told or what you think you understand, what somebody has said in a meeting. It's important to look at the actual written documents.
I have a question.
Mm-hmm.
Hey, so you stated that for employees that were laid off, that they can keep their 401k in with that employer. So what if you didn't get furloughed or laid off, and you left that employer to go gain employment with another employer? Can you still keep your 401k in with that former employer until you decide to roll it over? Or at some point, are you going to be forced to withdraw that as a cash, or be forced to roll it over by a certain date?
It depends on that plan's design, but if the amount in your 401k with that former employer is $5,000 or greater, they have to let you keep it in there until you reach normal retirement age, which is usually 65 under the plan. So they can't force you to do anything with it if it's over that threshold. If it's less than that, there can be mandatory cash out or rollover provisions in the plan.
So if they were an employer that had a contribution towards that balance, it's still just going to stay at that exact balance, and it will not accumulate any interest or a change in any way from an employer where you quit and you left, correct?
It's still going to stay invested in the market. So it will still ebb and flow with investment returns, and it will generate interest. So it will, assuming the stock market as well, it will increase in value because you have that money invested in the market.
Okay.
You just can't make any new contributions to it. And then with employer match, I should also say too, if you haven't met the vesting requirements before you left, you might end up forfeiting some of that match. So employers can have different vesting schedules. So if your employer has graded vesting over a 5-year period where you have to work for 5 years before being able to keep that match, but you only worked for 3, you would be able to keep 60% of the amount that they put in your account as match, because that's what you reached in terms of your vesting schedule, because they often put service requirements on the match in order to be able to. But there are some contributions depending on your employer's plan, like if it's a safe harbor plan, that those contributions are always vested and you get to keep them. So it's really important to look at your employer's SPD, a summary plan description, and any other materials they give you to see what you're entitled to keep in terms of their contributions. But anything you put in the plan yourself from your paycheck is always 100% vested. You always get to keep that. It might ebb and flow with investment returns, but that's money that you would never forfeit.
Thank you.
You're welcome.
I have a quick question on the 401ks and 403bs. I got rid of my 403b, but for the 401k, I was with an organization for 17 years and I vested after 5. So I did not take that money with me. I had maybe 2 hardship withdrawals thanks to children. The money that's left there, in addition with the employee contribution, do you get penalized if you don't use it? Like say if you, like if I have to take out if I get another 401k plan with another employer and I wind up using that fund versus the one that I already had, do you get penalized in any way? Because somebody told me you have to pay extra taxes on the prior one if you do.
I'm not aware of any rule that would penalize you for leaving your balance with the other plan and then choosing to do something with the current employer's plan, like take a distribution from that. No, I'm not aware of anything like that. I haven't heard of anything of that nature. No.
Okay. Thank you. I know it was a simple question, but it was really confusing.
I understand. Yeah, this stuff can be really confusing.
Kelly, I have a question along the same lines of keeping a 401k with a former employer. What is the benefit of doing that?
Well, it's beneficial because, like I said, these fees can really matter. I mean, especially if you roll it over to an IRA, like the fees that are available or the options that are available to you there to invest in, your broker or the money manager might take a significant cut for investing your money in those funds. Whereas with your plan, because of scale, and if your employer is pretty large, they get a much lower rate in terms of those fees. So you'd be paying less in fees by leaving it in an employer plan, most likely, than moving it to an IRA they could charge you more for access to those investments, essentially. So leaving it in a former employer's plan makes sense in terms of just fee management. And then you might be comfortable with the record keeper. We have Price, and their website is really easy to manage, and it's just, you can put stuff into a target date fund and kind of set it and forget it. So it just depends on what you want in terms of how you can manage your account balance and your retirement balance. And if you were to roll it over to a future employer, you would have those same benefits in terms of lowered fees and access to a plan's lineup, and you wouldn't be kind of paying a broker as you would potentially through an IRA to help you invest your money.
Okay, thank you.
You're welcome.
Kelly, I have another question.
Mhm.
Is it possible to roll over your 401k without penalty to your new employer?
Yes, it is, because you're not going to have access to that money if you do a direct rollover, which is the option that makes the most sense 99% of the time, because you're not going to have control over that money. You're just going to direct it to be rolled over to the new employer's plan, assuming that new employer accepts rollovers of money from another qualified plan, which many do. So there's no penalty for doing that because you don't ever have access to the money. It's just going to another plan.
And essentially what they do is they just write that check and they send it to your new employer's designated representative. And essentially that's it. There's nothing that you ever have to worry about. There's no fee that you have to pay. There's no tax.
There's no tax. There could be an administrative processing fee, as there often is with this kind of stuff. It's possible they could charge you a fee for transferring the amounts, but I'm not sure how much that would be. It might just vary by employer. But yeah, I would check in to see if there's a fee, but I would think it would be a kind of a pretty nominal fee, but I'm not entirely sure.
Okay. All right, very good.
Kellie, I just have a really general question. What are some of the most common retirement plan errors that you have to help clients with?
Yeah, that's a cool question. Sometimes it's possible, we've seen where employees get skipped, basically like excluded from the plan. If the plan has a rule where you have to be working for a year before you can be let in, but that employee worked for a year and due to just administrative processing error, the employee wasn't let in. And so they missed the opportunity to make contributions to the plan. And so the plan has to go in and make a contribution to their account to make up for that missed opportunity. And that money is usually always vested, and the employee gets to keep it. Another error would be if your plan has auto escalation, where if it says that we're going to increase your deferral percentage automatically every year, the first of the year, but then for whatever reason, administrative error happens with the record keeper and that doesn't happen, that's an error. And so depending on how much time has gone by, a lot of this too, it depends on how much time has gone by. The employer will be required to make a contribution to the plan to make up for that it's usually called a missed deferral opportunity for the employee. So those are the most common errors that we see in terms of administration. An employee has been either excluded from the plan or an amount was not increased when it should have been. Also too, sometimes amounts can be contributed too late, and so that's just another issue as well.
Okay, thank you.
You're welcome.
I have a question, Kellie. I know we've dealt with what the 401k means to us with furloughs and layoffs, but I just want to know a little bit more about your practice, because I know you practice working for corporate clients, right?
Mm-hmm.
I just want to know a little bit more about your particular practice.
Sure. I would say my practice is divided into 3 different categories, and the first is retirement issues. The second is health and welfare issues, and then the third is executive compensation issues. So helping employers administer all of these different benefits to their employees. And from a legal perspective, the DOL and various legislation requires that most of this all has to be in writing. So we prepare a lot of plan documents. We amend plan documents because of changes that employers want to make in their design of their plan and their benefits. There are a lot of record keepers and vendors involved in this whole process, whether they be insurance companies or third-party administrators who are administering things like COBRA or retirement plan platforms where they are, giving these investment funds for your plan to invest in and to open up to your employees. So we review administrative agreements with those vendors and providers and try, to protect the interests of the employer, and you review it from their perspective and make sure things are in the agreements that are beneficial to them and that don't put them or participants in a particular area of risk. And just day to day, sometimes research questions come up. There's always new laws coming out, especially this year. There's been so much new legislation. So sometimes I'll just have to, do a research day where I just have to look at secondary guidance and see how something's been interpreted. and apply it to whatever facts need to be applied for whatever issue the employer's facing. Other things, I have been involved in something new. It's employer assistance type of charity type of things, where an employer creates a fund to help employees who are going through financial issues, or disaster aid is a big one. And excuse me, the pandemic has been declared a presidential emergency, which has the same effect as a disaster. So a lot of employers are setting up these types of assistance programs where they help employees financially who are falling on, tough times from various disasters and pandemics, and then just issues that are, financial hardship. And so that's been a really rewarding thing that I've been doing in the last couple of years that I really enjoy. That's kind of an overview of different things that I do in my practice.
On the part where you're talking about in assisting employees, do you set up, when I worked for HCA, they had a program where we could donate out of our paycheck, like $4 a paycheck. And you think about across something that is nationwide, $4 a paycheck is a big amount when it comes down to it. And they would help people who were affected by hurricanes or had house fire or anything like that. Is that the type of programs that you're talking about?
It is, yeah. That's more of I do work on one for an employer that's similar to that, where it's large and national, and employees can just defer a part of their pay to help contribute to the charity. And so there are those big programs where they help people experiencing all kinds of financial disaster and hardship. And then there are also smaller programs too, where it's just limited to disaster aid. And those are for employers that don't want to create like a public charity, because you have to have a public charity to be able to give that type of financial assistance. You can do something on a smaller scale and just give disaster aid. So yeah, I work with the larger charities where it is employees contributing to this program that helps other employees and their families who've fallen on difficult times. And then some of the smaller scale too, for employers that are just doing disaster aid. And a lot of times those are just, grants of money for people impacted by wildfires or hurricanes, and now COVID too.
Thank you.
All right, well, if we don't have any more questions, we will wrap it up for today. Kellie, thank you so much. That's some really good, informative, interesting, and very topical information for us. Since most of us have 401ks or IRAs and retirement plans. If anybody, I think Amy posted about the CLE certificate. If anybody needs one of those, please email me, jennifer.mustaine@wallerlaw.com. I was going to let everybody know about the upcoming NALS Lunch and Learn for November. It's with John Bowers of Patterson Law, Intellectual Property Law. It is going to be on Law Firm Economics 101. So just look for that info in the next verdict and emails from me. Amy or Kellie Hughes, am I forgetting to say anything? Do y'all want to add anything?
I don't think we have anything to add. How about you, Amy?
I don't have anything to add at all. But we do thank everyone for being here today, and thank you so much, Kellie Money, for hosting for us today.
You're welcome.
Yes, thank you.
To you guys. Sorry, Kellie, I cut you off.
No, I was just saying thank you. It was very, very informative and good information for us to have, and I thought the questions were really good as well.
I agree.
All right. Well, since we have no more questions, everybody have a wonderful Wednesday and a wonderful rest of the week, and happy fall to everybody.
Thank you so much, Kellie, again.
Thank you, guys. Happy fall.
You too. Bye-bye.
Bye.
Oh, no, no, no. I've got to stop the recording.